Well, let's bring in Paul Gambles, the co-founder and managing partner at MBMG Group, joining us from Bangkok. Paul, thank you so much for joining us today. Will was mentioning the war drums beating just a second ago, and it's really interesting when you take a look at history, the way that in the lead up to a war, you often see the markets reacting the way they have been of late, very skittish, very nervous, very volatile. And then when there is, and it's a horrible way to put it, and I'm not underplaying, the terrible human toll here, but when there's actual clarity, when you actually see the war start, quite often the markets then rally. Is this a scenario that could play out this time as well?
Yeah, good morning, Mandy. Are you not going to sing some Lionel Richie for us to give us a bit of a mood for this? But we just kind of, I suppose, push back a little bit and say, I think that war is, if anything, perhaps a little bit less likely than it was a few days ago. It's always been a fairly small probability. I think the risk of war is really like 1913, sleepwalking into war by mistake. And I guess the events of the last few days, although markets have been a bit spooked by them, if anything, they sort of give us a little bit of clarity in that, Luhansk and Donetsk, the oblasts there have now been recognized as republics. So I think we might be at a point where we've sort of reached a general level of peak fear, but we're likely to continue with elevated tensions for probably quite a long time, and I think people might just kind of get bored with that eventually, as you were sort of saying. So I think they might just reach a point where 6 months' time we're still in the same situation we are now. Then people are just get used to it, and they just take that out of the factoring of markets and asset prices.